If you don't currently own silver but you're considering it, you need a different framework. The first question is, why now? Not why silver in general, why this specific moment? What has changed in your understanding, in the market, or in your financial situation that makes silver allocation appropriate? If the answer is because prices are going up, that's the wrong reason. Chasing momentum is speculation, not investing. The right reason is that you've studied the fundamentals, you understand the risks, and you believe that over a multi-year time horizon, silver offers asymmetric potential relative to its downside. Let's be clear about the risks. Silver can be extremely volatile. It can fall 30, 40, even 50% from highs during corrections. If you can't emotionally or financially handle that, you shouldn't be in the asset. Silver offers no yield. It sits there. It doesn't pay dividends. It doesn't generate cash flow. Your only return comes from price appreciation. That means it's only appropriate as a portion of a diversified portfolio, not as a core holding. Timing is difficult. You might buy today and watch prices fall for months before the structural moves unfold. You need to be prepared for that possibility. Now let's talk about how to think about allocation. Most financial advisors suggest that hard assets, precious metals and other real assets, should represent somewhere between 5 and 15% of a portfolio for someone with moderate risk tolerance. That range makes sense for most people. If you're more conservative, lean toward the lower end. If you're more aggressive or particularly concerned about monetary instability, you might justify the higher end. But whatever you decide, the allocation should be something you can hold through volatility without losing sleep. Here's a strategy that makes sense for most people considering silver now. Start with a small position. Don't try to time the perfect entry. You can't. No one can. Instead, buy a modest initial position, say a quarter of what you ultimately plan to allocate. Then, dollar cost average over the next 6 to 12 months. This approach removes the pressure of perfect timing. It allows you to accumulate through volatility. It reduces regret if prices fall after your initial purchase. If you're buying physical silver, understand the premiums you're paying over spot price. Premiums fluctuate based on demand for retail products. During high demand periods, you might pay significant premiums that take time to recover through price appreciation. If you're buying through exchange-traded products, understand the structure. Some hold physical metal, others use futures contracts. The differences matter for tax treatment and tracking to spot prices. If you're considering mining equities, understand that they're not the same as owning silver. They offer leverage to the metal price. They tend to move more than silver itself in both directions. They also carry company-specific risks: management quality, production costs, jurisdiction, reserve life. Mining stocks can be explosive on the upside, but they're also much more volatile. They're appropriate for a smaller portion of your allocation, and only if you're comfortable with equity risk. Whatever route you choose, the key principle is this. Start with education, allocate according to your risk tolerance, and commit to holding through volatility. Don't buy with money you'll need in the next year. Don't buy with borrowed money. Don't buy on the assumption that prices will immediately move in your favor. Buy because the fundamental case makes sense, and be prepared to be patient. Let's talk about the mistakes that destroy wealth during these periods. The first mistake is over-leveraging. Silver's volatility makes it tempting to use leverage, buying on margin, using options, trading futures. The logic seems sound. If silver is about to move significantly, why not amplify your returns? Here's why. Because even if you're right about direction, volatility can stop you out before the move unfolds. Leverage turns temporary drawdowns into permanent losses. Every market cycle, we see the same pattern. Investors leverage up, prices spike, then prices correct violently. Leveraged positions get liquidated at the bottom. The metal then continues higher, but those investors are already out of the game. Don't be that person. If you can't hold silver without leverage, you can't afford silver. Full stop. The second mistake is emotional trading. Silver will test your conviction. It will rise, then fall, then rise again. Each move will feel like it should prompt action. You'll be tempted to sell into strength to lock in gains. You'll be tempted to sell into weakness to stop the bleeding. Most of those impulses will be wrong. The data on investor behavior is clear. The average investor in volatile assets significantly underperforms the asset itself because they trade at the wrong times. They sell bottoms and buy tops, driven by emotion disguised as analysis. The way to avoid this is simple but difficult. Make decisions in advance. Decide now what would cause you to sell. Write it down. Make it specific. Not if I get nervous or if prices fall. Make it objective. If the supply deficit reverses, if industrial demand collapses, if the monetary backdrop fundamentally changes. Then stick to those rules. Ignore everything else. The third mistake is following social media hype. Silver has a passionate online community. That's both a blessing and a curse. The blessing is you can find education and community. The curse is you'll also find endless speculation, conspiracy theories, and hype. You'll see price targets that have no basis in analysis. You'll see claims that silver is about to explode every single week. You'll see people claiming they're leveraged to the maximum, that they've sold everything else, that silver is the only thing worth owning. Ignore all of it. Those voices are not your friends. They're not trying to help you. They're expressing their own emotional needs, their own biases, their own financial decisions. Your situation is different from theirs. Your risk tolerance is different. Your time horizon is different. Make decisions based on your own research, your own analysis, your own situation. Use others' perspectives as input, but never as instruction. The fourth mistake is ignoring diversification. No matter how compelling the silver case is, it's still one asset in one market. Things you don't anticipate can happen. Assumptions you've made can prove wrong. That's why diversification exists. Not to maximize returns, concentration does that, but to manage the risk that you're wrong or that circumstances change in ways you didn't foresee. If silver becomes your entire portfolio, you've moved from investing to gambling. Don't make that mistake. The fifth mistake is expecting immediate vindication. You might buy silver today and watch it fall tomorrow. You might hold for 6 months and see no movement. You might endure a year of consolidation before anything significant happens. That's normal. Markets don't validate your decisions on your preferred timeline. They move when they move, based on flows and fundamentals and psychology that operate on their own schedule. If you need immediate validation, if you need to see your position move into profit quickly to feel good about the decision, you're not ready to hold silver. Investing in asymmetric opportunities requires accepting that you'll look wrong, sometimes for long periods, before you're proven right. If you can't handle that psychologically, you should reconsider your allocation. We're living through a transition in the global monetary system. It's not happening overnight. It's not a single event, but the long-term trend is clear. The dollar's role as the sole reserve currency is gradually diminishing. Not disappearing, diminishing. Other currencies, other payment systems, other stores of value are slowly gaining ground. Debt levels have reached extremes that historically have only been resolved through inflation, default, or restructuring. Inflation is the most politically palatable option, which means it's the most likely. Demographic shifts are creating structural pressures that will persist for decades. Aging populations in developed nations mean higher healthcare and pension costs, lower productivity growth, and increased pressure on government finances. Technological disruption is accelerating, creating both opportunities and instabilities. The transition to renewable energy, to electric vehicles, to digital infrastructure, these are multi-decade trends that will require enormous amounts of industrial metals. Into this environment, you need assets that can preserve purchasing power, that have fundamental demand drivers, that aren't just financial claims backed by promises. Silver is one of those assets. It's not the only one. It's not necessarily the best one for everyone, but it occupies a unique space in the asset universe. It's small enough that institutional flows can move it dramatically. It's liquid enough that you can get in and out. It's used in ways that ensure ongoing demand, regardless of financial market sentiment. And it's historically undervalued relative to the monetary uncertainty we're facing. That doesn't mean it's a sure thing. Nothing is. But it means the probability distribution is skewed in favor of holders. Here's what that means in practical terms. If you're right about the macro environment, if the currency pressures intensify, if inflation remains elevated, if trust in financial institutions weakens, silver could appreciate substantially over the next several years. If you're wrong, if somehow central banks navigate this perfectly, if debt doesn't matter, if inflation falls back to target and stays there, silver might not do much. You might earn nothing. You might even lose some value in real terms. But here's the asymmetry. The upside scenario involves multiples. The downside scenario involves modest losses. That's why silver makes sense as part of a diversified strategy, not as a bet, as insurance with upside. You're allocating capital to an outcome that, if it occurs, will more than offset the cost if it doesn't. That's rational risk management in an uncertain environment. We've covered a lot of ground here. The macroeconomic backdrop, the supply and demand dynamics, the historical patterns, the psychology of markets, the practical considerations for both holders and potential buyers. Now let's bring it together. You're standing at a moment where the conditions for a significant repricing in silver are aligning. That doesn't mean it happens tomorrow. It doesn't mean it happens in a straight line. But the setup is there. If you hold silver, your patience may be about to be tested in a different way, not by continued stagnation, but by volatility on the upside. Your job is to stay disciplined, avoid emotional reactions, and remember why you bought in the first place. If you're considering silver, now is the time to educate yourself, make a rational decision about allocation, and commit to seeing it through, not because prices might go up next week, but because the fundamental case is compelling over a multi-year horizon. Either way, the key is the same. Understand what you own, why you own it, and what would have to change for that thesis to be invalidated. The investors who do well in these environments aren't the ones with perfect timing. They're not the ones who get lucky. They're the ones who do the work, who stay disciplined, who manage risk, who keep their emotions in check. They're the ones who understand that markets move in cycles, that volatility is the price of admission for asymmetric returns, and that patience is more valuable than prediction. The crisis isn't some future event we're trying to predict. The crisis is here. It's embedded in the debt levels, the currency instability, the inflation dynamics, the geopolitical tensions. We're living through it right now. The question is whether you're positioned for it, not positioned to profit from disaster, positioned to preserve wealth, to maintain purchasing power, to come out the other side with your financial security intact. That's what real assets offer in unstable times. Silver is one piece of that puzzle. It's not the whole solution, but it's a piece that deserves your attention right now. The decision you make, to hold, to buy, to pass, to sell, will depend on your specific situation, your risk tolerance, your time horizon, your other holdings. But whatever you decide, make sure it's a decision, not a reaction. Make sure it's based on understanding, not emotion. Make sure it's something you can stick with when prices do what prices always do. Move in ways that test your conviction. Because here's the truth. The market doesn't care about your feelings. It doesn't care about your timeline. It doesn't care whether you're patient or impatient, educated or confused, disciplined or emotional. It will do what it does based on flows and fundamentals and the collective psychology of millions of participants. Your job is to position yourself rationally within that reality, to understand the cycles, to manage risk, to avoid the common mistakes, to stay focused on what matters. And to remember that building wealth is a long game, not a series of short sprints. The investors who understand that, who can see beyond the noise, beyond the volatility, beyond the daily drama, are the ones who will look back years from now and recognize this moment for what it was. A breaking point, a transition, an opportunity, not to get rich quick, but to protect what you have and potentially grow it substantially over time. That's what this moment offers. The question is whether you're prepared to see it through. Stay informed, stay disciplined, stay patient. And trust that if you've done the work, if you understand the fundamentals, if you're managing risk appropriately, you'll be fine, regardless of what happens in any given day or week or month. Because in the end, that's what separates successful investors from everyone else. Not perfect predictions, not lucky timing, not insider information, just discipline, education, and the emotional maturity to let long-term thinking guide your decisions. That's how you navigate moments like this. That's how you make decisions that define your future. Something has shifted, not overnight, not because of a single headline or tweet, but gradually, steadily, the forces that move real assets have realigned in a way we haven't seen in over a decade. If you hold silver, or if you've been watching it from the sidelines, this moment demands your attention, not because of panic, not because someone on the internet told you to act, but because the underlying conditions that determine value in hard assets have fundamentally changed, and most people don't see it yet. That's not unusual. The most significant financial shifts are rarely obvious when they're happening. They reveal themselves slowly in data points and policy decisions, in the quiet accumulation by institutions, in the growing gap between what markets price today and what reality suggests tomorrow. This script is not here to sell you anything. It's here to walk you through what's actually happening in the silver market right now, what it means, and how you should think about it, whether you already own the asset or you're trying to decide if you should. We're going to move through this carefully. We're going to look at the macroeconomic backdrop, the supply and demand dynamics, the historical patterns, and most importantly, the psychology that causes investors to make poor decisions at exactly the wrong time. By the end, you'll understand why this moment is different, and you'll know what to do about it. Let's start with what most people miss. Silver is not just a commodity. It's not just a metal you buy for speculation or jewelry. It occupies a unique position in the financial system. Part industrial metal, part monetary metal, part hedge against instability. And right now, all three of those roles are under pressure. For years, silver traded in relative obscurity. It wasn't fashionable. It wasn't exciting. While other assets captured headlines, silver moved sideways, frustrating those who held it and boring those who didn't. But beneath the surface, something was building. Global debt has expanded beyond anything we've seen in modern history. Central banks, after years of claiming they would normalize policy, have found themselves trapped in a cycle of intervention. Inflation, once dismissed as transitory, has embedded itself into the cost structure of economies around the world, and industrial demand for silver has accelerated at a pace that few anticipated. Here's the thing most investors don't understand. Silver is consumed. Unlike gold, which is mostly held in vaults and recycled endlessly, silver is used in ways that remove it from circulation. Solar panels, electronics, medical devices, electric vehicles, 5G infrastructure. Every year, more silver leaves the market permanently than enters it. At the same time, mining supply has been constrained. Exploration has been underfunded. New projects take years to bring online. Recycling can't fill the gap because much of the silver used industrially is in such small quantities per device that it's not economically recoverable. So you have rising demand, falling supply, and a market that, for years, priced silver as if none of this mattered. That's changing. Not all at once, not in a straight line. But the repricing has begun, and the question you need to ask yourself is whether you understand what happens next. To understand silver's position right now, you need to understand the environment we're in. Let's talk about debt first. Governments around the world are carrying debt levels that, historically, have only been seen during major wars. The United States alone has debt exceeding $36 trillion. That's not a political statement. It's a fact. And here's what matters. That debt has to be serviced. Interest payments are now consuming a larger portion of government budgets than defense spending in many developed nations. When debt becomes this large, governments face limited options. They can raise taxes, which slows economic growth. They can cut spending, which is politically painful. Or they can inflate the currency, which reduces the real value of the debt over time. History shows us which option governments choose. Inflation is not some abstract concept. It's the silent transfer of wealth from savers to debtors, from those who hold cash to those who hold real assets. And while headline inflation numbers may rise and fall, the long-term trend in currency debasement is unmistakable. Now let's talk about interest rates. For over a decade, we lived in a world of near zero rates. Central banks convinced themselves they could keep rates low indefinitely, that debt didn't matter, that modern monetary theory had solved the old problems. They were wrong. Rates rose sharply as inflation forced their hand. But here's the problem. The system can't tolerate high rates for long. Not with this much debt, not with this much financial fragility. So we're entering a period where central banks will be forced to choose between controlling inflation and preventing a debt crisis. They can't do both. And that's where silver becomes relevant. Because when currency confidence erodes, when real rates turn deeply negative, when investors realize that holding cash means guaranteed loss of purchasing power, they move into assets that can't be printed. Gold gets most of the attention, but silver, with its industrial demand base and smaller market size, offers something gold doesn't: asymmetry. It takes far less capital to move the silver market than it does to move gold. When institutional money begins to recognize this, when the flow of capital shifts even slightly, the price response can be dramatic. We're not there yet. But the conditions are aligning. Let's get specific about the supply-demand imbalance. According to industry research, the silver market has been in deficit for 3 consecutive years. That means more silver is being consumed than produced. The deficit is being filled by above-ground inventories, stockpiles that have accumulated over decades. But those stockpiles are finite. And here's what most analysts miss. Those stockpiles aren't all available. Much of it is held by long-term investors who aren't selling at current prices. Some of it is held by governments or institutions as strategic reserves. Some of it simply isn't for sale at any realistic price. So the effective available supply is much smaller than the total inventory suggests. On the demand side, the growth is accelerating. Solar energy installations are expanding globally. Each solar panel requires silver for conductivity. As countries push toward renewable energy targets, this demand is structural, not cyclical. It's not going away if the economy slows. If anything, government subsidies and mandates ensure it continues regardless of market conditions. Electric vehicles use significantly more silver than traditional cars. As EV adoption grows, so does silver consumption. The same applies to the broader electrification of the economy, from grid infrastructure to charging stations to battery technology. Then there's investment demand. For years, investment demand for physical silver was modest. Retail buyers purchased coins and small bars, but institutional involvement was limited. Exchange-traded products held some silver, but nothing that would move the market significantly. That's beginning to change. As trust in traditional financial instruments erodes, as concerns about bank stability resurface, as inflation expectations remain elevated, more investors are looking at physical assets as insurance. Silver offers something unique in this environment. It's more affordable than gold for retail buyers. It has industrial utility that provides a fundamental floor to demand, and it's historically undervalued relative to gold by most long-term metrics. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 55 over the past century. Right now, it's trading well above that historical average. That doesn't mean it has to revert. Markets can stay irrational far longer than you can stay solvent, as the saying goes, but it does tell you something about relative value. And it suggests that if both metals move higher in response to monetary instability, silver has more room to run on a percentage basis. Let's look at what happens to silver during periods of currency instability. In the 1970s, as inflation surged and confidence in fiat currency weakened, silver rose from under $2 per ounce to nearly $50 by 1980. That's a 25-fold increase in a decade. Now, we're not predicting a repeat of that. Every cycle is different. But the underlying cause was the same thing we're seeing today: currency debasement, rising inflation, loss of faith in government fiscal discipline. What's interesting is what happened before that move. Silver spent years in a range, frustrating investors who expected immediate gains. It wasn't until the macroeconomic conditions reached a tipping point that the market repriced rapidly. The same pattern played out in the 2000s. Silver spent the early part of the decade below $5. It seemed forgotten. Then, as the housing bubble formed and the central banks flooded the system with liquidity, silver began to move. By 2011, it had reached nearly $50 again. Again, we're not saying that's about to happen. But the pattern is clear. Silver remains dormant for long periods, then reprices violently when monetary conditions shift. The investors who did well in those periods weren't the ones who tried to time the bottom perfectly. They weren't the ones chasing momentum after the move had already started. They were the ones who accumulated position during the quiet periods, who understood the underlying dynamics, and who had the patience to wait for the market to recognize what they already knew. That's the psychology we need to talk about. Because most investors do the opposite. They ignore assets that aren't moving. They buy after prices have already surged, driven by fear of missing out. They sell at the bottom when prices correct, driven by fear of further losses. Understanding market cycles means understanding human nature. Fear and greed drive short-term price movements, but long-term value is determined by fundamentals: supply, demand, monetary policy, fiscal reality. If you can stay focused on fundamentals while others react emotionally, you have an enormous advantage. Here's something most retail investors don't see. Institutional involvement in silver has been minimal for years. Large funds, pension managers, sovereign wealth funds, they've largely ignored the metal. It hasn't fit their mandates. It's been too small, too volatile, too unsexy. But that's changing. As macro funds wake up to the structural deficits, as commodity desks begin modeling the supply constraints, as ESG mandates push institutions toward metals used in green technology, we're seeing early signs of repositioning. It's not obvious yet. Institutions don't announce their moves in advance. They accumulate quietly through derivatives and physical purchases, building positions before the market realizes what's happening. But the flows are starting to show up in the data. Exchange-traded products are seeing renewed inflows after years of stagnation. Warehouse inventories tracked by exchanges are declining. Lease rates, what it costs to borrow silver, have been rising, indicating tightness in the physical market. These are subtle signals, but they matter. Because if institutional money begins to enter silver in earnest, the price discovery process will be very different from what retail investors are used to. Institutions think in position sizes that are multiples of the available supply. They don't buy dips and sell rips. They accumulate over months, sometimes years, building strategic positions. When that capital is deployed, it doesn't just move prices, it reprices markets. And here's the key point. Retail investors won't know it's happening until it's already happened. By the time silver makes headlines, by the time it's the top performing asset in financial media, the institutions will already be positioned. The opportunity for asymmetric gains will have narrowed. This isn't a call to rush in. It's a reminder that market timing is difficult, that understanding cycles matters more than predicting exact turns, and that being early looks the same as being wrong until it doesn't. If you're someone who already owns physical silver or exposure through funds or mining equities, you need to think carefully about your position right now. First, acknowledge that you've been patient, perhaps frustrated at times, perhaps questioning whether you made the right decision. That's natural when an asset moves sideways for years, but patience is about to be rewarded or tested further. Which outcome unfolds depends on how you manage your psychology and your position from here. Here's what you need to do. Revisit why you bought silver in the first place. Was it insurance against currency debasement? Speculation on price appreciation? Diversification away from financial assets? Your original thesis matters because it determines how you should think about the current environment. If you bought silver as insurance, then you should be holding regardless of short-term price movements. Insurance doesn't pay off until the event you're insuring against happens. Selling insurance before the crisis is the worst possible strategy. If you bought silver for price appreciation, you need to assess whether the fundamental case has strengthened or weakened. Based on everything we've discussed, the supply deficits, the industrial demand, the monetary backdrop, the fundamental case is stronger now than it's been in years. That doesn't mean prices go straight up. It means the probability of substantial repricing has increased. Now let's talk about what not to do. Don't get emotional about short-term volatility. Silver is a volatile asset. It always has been. Price swings of 5, 10, even 20% are normal, especially as the market reprices. If you can't handle volatility, you're in the wrong asset. Don't try to trade around your position unless you're an experienced trader with a proven system. Most people who try to sell high and buy back lower end up selling before the real move begins, then chasing prices higher. The data on this is clear. Most traders underperform simple buy and hold strategies. Don't tell yourself you'll sell once you break even or hit some arbitrary price target. That's emotional thinking, not strategic thinking. If the fundamentals support holding, you hold. If they don't, you sell. Your entry price is irrelevant to the asset's current value. Here's the right mindset. You're holding a real asset in an environment where monetary stability is questionable, supply is constrained, and demand is growing. That's a favorable setup. The market may not recognize it immediately, but eventually prices reflect reality. Your job is to stay rational, avoid emotional decisions, and trust the process you committed to when you made the initial investment. If you're concerned about concentration risk, if silver represents too large a portion of your portfolio, then rebalance systematically, not emotionally. Set rules in advance. Follow them regardless of what the price is doing in any given week. And most importantly, stay educated. Understand what's driving the market. Read the supply reports. Watch the macro data. Follow the institutional flows. Knowledge reduces anxiety and improves decision making.